Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will look at the bumpy markets this past week. John Rubino from DollarCollapse.com takes a look at what's happening to silver and why. Mike Swanson from WallStreetWindow.com says changes in the equity markets as the so-called Trump effect fades could produce some plays in the gold and silver markets. And a reminder that at the end of the show, we'll have company showcase updates with Brian Fowler, the president of Blind Creek Resources, and Larry Ray, the CEO and president of American Manganese. We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Good to be with you, Jim.
The equity markets, boy, they still continue to set record highs.
Yep. You know, what was it, a week and a half ago, we had that quick pullback, 2% or thereabouts, created an interesting bout of negativism. We had actually the percentage of bulls on the American Institute of Investors dropped down below 25%, and that typically you don't see that until the market's been down for a number of weeks. But in this case, it only took a number of days to really shake the tree here and get the negative feelings there. So by the middle of this week, things had been up to new highs, in particular led once again by technology. The XLK, which is the ETF for technology stocks, screaming away here on the upside to new highs. NASDAQ's up there. The FANG stocks, the Facebook, Amazon, Netflix, and Google, all having pretty good week here. But, you know, if we look below the surface, you see that the breadth is really starting to diminish. Right now, for all the, we made a new high on the S&P. 60% of the stocks in the S&P right now are below their 50-day moving averages. And in Canada, only 46% of stocks are above their 50-day average. So this market is starting to really become one that's very, very selected. And, you know, we take a look at the AD line, it's advanced decline line. That is failing to confirm the new highs. You look at the classic Dow theory, which is when you're going to be seeing the strength of the Dow Industrials versus the transports and the utilities, and you're looking to see how strong the economy is. Now, the industrials are doing just fine, but the transports have really had a tough calendar quarter, and they're about 4% off the highs right now. This type of divergence can be setting up for at least an interim type of high.
The Canadian financials just had their quarterly reports, and they're doing very well.
The reports come out well. The stocks, other than BMO, which took it on the nose on the first day by about 3%, the others bounced reasonably well initially, but they'd also been one of the most oversold categories here in the Canadian market. Had a good bounce right off the earnings, but started to slide a little bit in the latter part of the week. I am watching pretty closely here the TSX Industrial Index. If you look at that, and the Chaikin money flow, which looks at, it's an oscillator that watches the flow of funds in and out. It failed to rally very well following the February top that we had in the Canadian market. And it's actually now it's just flirting with its major support line. And it's going to be very, very important, I think, as we move through the next couple of weeks to see that holds. And this next few weeks stretch is important when I look at the cyclic work that I have. We talk about the presidential cycle. and how in the first term of a president, after you've had a non-incumbent election, which is what we had this time around, when you've had a positive year, as we did last year, the norm is that you would have that first rally into February, March. You'd get that 3 to 7% correction, followed by a new high. So we've had all of those things come into play. But if we look at from when that original peak happens, in this case in February, and we measure forward, there's a window out here that looks to be about the middle of June, where we should be looking for the next interim high. And the norm would be that we drop back and come to our 150-day moving average for the Dow and the S&P. And in round numbers, just extrapolating out, that's probably about 4% below the market. So by the time we get out the second half of June into July, I think that's the type of exposure that there might be in the broad market.
OPEC said it's going to extend their production freeze for another 9 months. What happened when they announced that?
Well, it was absolutely no surprise. There was nothing over and above what was already in the market. So this clearly was a buy the rumor, sell the fact type of item. So these quotas is being extended into 2018. Between the Russians and the frackers, I mean, really it's the question here of, will the production caps stay in place, and even if they are in place, will the differential not be made up by these other producers who don't have to abide by it? I guess I should add Nigeria to the list there as well. So, I think we've got oil stuck in a trading range. It did get the hard $3 break after the announcement, but it bounced back on Friday. It's probably now in this $47 to $52 to $55 trading range unless something different happens. I still view 47 as a very important catalyst point. If it were to break there, then we would be looking for the low 40s. But, the Saudis are going to do everything they can with their stock offering coming up down the road. They're going to do everything they can to keep oil reasonably stable.
Ross, thanks a lot for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Brian Fowler, President of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Good to be back, Jim.
John, is there an abundant supply of silver?
It depends on who you talk to and what the silver is being used for. There's plenty right now. If you and I want to go out and buy silver coins, no shortage. We can buy it with no trouble. But in the long run, we're using up silver because it's an industrial metal, and a lot of the uses for it are, almost trace amounts, but in the aggregate, it ends up being quite a bit. For instance, your phone has a little bit of silver in it. The solar panels on your roof have a little bit of silver. And in the aggregate, it comes to quite a bit, and a lot of that isn't recycled, so it's just gone. So we are running through the available silver and not replacing it, which means that the available supply for investors, in other words, the people who want to buy gold and silver coins, or silver coins, and save them for a long period of time as the risk-free part of their portfolio, the supply of that kind of silver is eventually going to dry up, and that's part of the really interesting investment thesis for silver, is that we're using it up. Whereas with gold, basically all the gold that's ever been mined is still sitting in vaults or safe deposit boxes somewhere, because it's mostly a monetary metal. Silver is partially monetary, partially industrial, and the industrial part is used and lost.
How much silver is being used in solar?
Solar's a great story for silver because basically 5 or 10 years ago it was minimal. You know, we just didn't produce that many solar panels because solar was very expensive and it was really a niche market in the energy world. But it's been getting cheaper and cheaper year after year to the point where it is now cheaper than coal-generated electricity in a lot of places. And coal has been the dominant energy source for electricity for the past 50 years. So solar is displacing coal, and it's going exponential. We're adding more solar power around the world than anybody thought was likely even a decade ago. And the trend is continuing, especially in places like China and India where they have horrendous pollution problems. They're shifting to solar really aggressively. So it's looking like this year solar alone will soak up about 10% of the mine production of silver out there. And that part of silver demand is increasing exponentially with no real end in sight until they come up with the technology for solar panels that doesn't require silver. That day is out there somewhere, but it's not imminent. So the next few years should see dramatically increasing demand from solar power for silver. And that's demand that didn't exist 5 or 10 years ago in any appreciable scale. So it's a big new piece of the puzzle that should get better from silver's point of view going forward, at least for the next few years and possibly quite a bit longer.
Now, as an example of just how popular solar can be, at some points is it true that 50% of California's power is being supplied by solar?
There was a day in March when, it was a sunny day, and the state's solar panels generated lots of electricity, and it ended up being about half of what the state used for a few hours during that day. Now, that is astounding when you consider that solar was less than 1% of global energy production just a few years ago, and it's only a little above 1% right now. So for a major state like California to get 50% of its electricity from solar panels is an astounding change in a very short period of time. And it's not reversing and it's not moderating. That trend is increasing in arc. In other words, the growth of solar demand is accelerating from an already high level lately, and it shows no sign of letting up because solar gets cheaper and cheaper year after year, while electricity generated by coal-fired power plants and by natural gas tend to be fairly stable over time. So as the difference between the cost of solar and the cost of coal widens, there's really no reason, say, 5 years from now, to ever build another coal-fired power plant. And you're seeing that happen around the world where coal-fired plants are either being closed or the ones that were on the drawing board are being canceled because solar is just better and cheaper now. And, that's just a snapshot of the present. What gets really exciting is that solar, because it's getting cheaper, is going to be more and more advantageous or more and more competitive in the global marketplace. So that in places that aren't extremely sunny right now, where solar is still way too expensive relative to coal, it's going to get more and more competitive to the point where even in, say, Germany or the UK, which aren't especially sunny places, solar is going to be flat out cheaper with no subsidies than any other major source of electricity. And so basically it's game over for fossil fuels, and it's the beginning of the age of solar power, which is phenomenally good on a lot of different levels. You know, it might possibly be the thing that slows and stops climate change, if indeed, you know, we are contributing to climatic instability. Solar is a big part of the solution to that. And from our point of view as silver bugs, Jim, it's a good thing because it means a lot of silver is going to be taken off the market here pretty soon, and much of it won't be put back on at any time in the future because the amount that goes into a solar panel is pretty minimal. You know, in the aggregate it's a big number, but in any individual solar panel it's not much, so it's not really economic to recycle the silver out of most solar panels now, which means that a lot of that silver will just be lost.
How does the commitment of traders look for silver?
Well, the Commitment of Traders report is a snapshot of what the big players are doing in the futures market for precious metals. And historically, when speculators get very excited, which is something you can see in the Commitment of Traders report by a really long position for money managers, that tends to be bad for the future price of silver because it means the speculators who tend to trade on emotion and are usually wrong at big turning points are happy. And when they're happy, the price usually goes down. That was the case up until about a month ago. You know, speculators had gotten very excited, and inevitably there was a correction coming, and it came. You know, silver got whacked, and now the speculators have at least partially bailed out of their long positions. So the silver market is either in balance or somewhat favorable, which means that we shouldn't be too worried about big drops in the short run in the price of silver, in which case fundamentals can win out, and silver ought to be reasonably firm going forward for a while, you know, until the speculators get excited again. But, it's possible for silver to go up at varying rates, you know, have a long-term bull market and still have fluctuations based on what the big futures players are doing. So, you know, we could see silver go to $50 an ounce and still have periods when the speculators were overexcited and silver gets whacked, and then they get pessimistic and it goes up. You know, there's still a kind of a boom and bust element to silver prices, but it can be in the context of a long-term bull market, which is what I think we'll see going forward.
Does the gold-silver ratio provide a good indicator for silver?
Yeah. Silver historically was about 15 to 20 ounces per ounce of gold. And lately it's gone up. You know, and that's usually an indicator that there's a correction in the gold-silver ratio coming, which means that silver will go up relative to gold. We're around 75 ounces of silver per ounce of gold right now, which historically is a buy signal for silver, at least relative to gold. You know, they could both go down, but silver go down less dramatically than gold. But what normally happens is that silver goes up faster than gold from points like this. So that's another data point that's positive for silver and neutral for gold. It doesn't really tell us that much about gold, but it does say that silver ought to do well going forward. So you got, at least in the short run, you've got a Commitment of Traders report that is neutral to positive, and you've got a gold-silver ratio that's very positive for silver. So based on history, this looks like a pretty decent entry point if you want to buy some more silver or if you want to start a buying program for silver. But having said all that, you should never jump in with both feet to something as volatile as precious metals. You should always dollar cost average, at least to an extent. That is, buy about the same amount of something you want to accumulate each month or the same dollar amount. And that means over time, you'll buy more when prices are down and less when prices are up, so your average price will be pretty good. And that's the way to approach something like silver, which can be extremely volatile and therefore really dangerous if you just buy a bunch all at once. Buy a little over time, and over time it will probably work out.
We'll have more with John Rubino next on This Week in Money.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. John, in bull markets, how does silver trade relative to gold?
Well, silver's way more volatile than gold because it's a smaller market and silver is much cheaper, so more money relative to the amount that's available flows into silver than into gold in bull markets. So silver does better. It also goes down more in bear markets. So when you want to focus on silver is when you expect overall precious metals prices to be pretty strong. I think that's the case now based on some of the stuff we just talked about. The overall fundamentals in terms of how much money the governments of the world are borrowing and inducing their citizens to borrow, that's the underlying fundamental positive for precious metals, because they have no choice at some point, the governments of the world, but to inflate away their currencies to get out from under their debts. So that's the long-term positive fundamental. In the short term, you got the stuff we talked about before, the commitment of traders report and gold-silver ratio, stuff like that, and they look reasonably positive too. So based on that kind of history, you would expect silver to do better than gold over the next couple of years. And it's possible that it could do dramatically better than gold just because it's such a thin, tiny market. There's just not that much silver available in dollar value terms out there. So that if people get excited about it, and even, half of 1% of global capital decides to flow into silver, it's a rocket ship, it'll just take off. It'll look like Bitcoin has looked like lately, where it just takes off and doesn't look back. And that day is coming for silver out there. I wouldn't presume to call a date, and say that now is the time, or a year from now is the time, or whatever. But somewhere out there, a stretch in which silver goes from wherever it is when it starts to $100 or $200 an ounce. That day is coming, and you want to have some silver in anticipation of that.
Jim Dines is predicting the price of silver will surpass the price of gold. Is that really going to happen?
That would be amazing if it did. I mean, not amazing in the sense that it's a stupid prediction, but amazing from the point of view of the guys who own silver, because that's a long run. If silver exceeds the price of gold, that would be astounding. Now, how possible it is depends on supply-demand dynamics. And as I said, we're pulling a lot of silver out of circulation by using it for industrial products and then not recycling it. So it's possible that in a small, thinly traded, highly volatile market like this, where the supply-demand trends are, aggressively favorable, that you could see silver just take off. And whether it goes above gold's price or not, I don't know. That starting from here, that would be an amazing run. But I think you can say with a fair degree of certainty based on historical trends and current supply-demand dynamics, that silver ought to go way up from here. So I don't know about the ultimate target, but I do think that people who own silver at today's prices will end up being really happy with that decision.
Do you see a time when the price of silver bullion will surpass the face price of silver coins and people just melt their coins down?
Yeah, maybe, especially if there's any kind of a confiscation. You know, if the government singles out one aspect of silver and tries to call it in or make it illegal to trade or something like that, then you could see them swapping silver coins for some other form of silver that isn't subject to the same regulations. So if silver coins are the things that government targets, then you melt them down, turn them into bullion, and sell the bars then if you need to. But I don't think that's as big an issue as it would be with gold, where, you know, we have in living memory had a gold confiscation where the government took people's gold away and made it illegal to own it. So that is, should gold be seen as a threat to the fiat currency establishment, that's a possibility again. It's not likely at this point because back in the 1930s when we had that gold confiscation, gold was literally money. That was something that you spent in stores. Today that's not the case. And until it becomes the case, it's less necessary from the point of government to restrict gold because it isn't seen as the main threat to the value of fiat currencies. You know, there are lots of other problems with fiat currencies that don't necessarily involve gold right now.
Well, the Indian government did raid people's homes looking for gold and silver. Could governments get that desperate?
Oh, they'll get desperate. It's just that the really big pot of untaxed money right now is in IRAs and 401ks in the U.S., and probably the equivalent in Canada, where, you know, there's trillions of dollars just sitting there. And a desperate government could easily go after those things. You know, take my IRA account, confiscate the stocks and bonds that are in there, and repay me with government treasury bonds or something, so that I'm, you know, an unwilling financier of government deficits at that point. And that's something that could easily happen when things get really crazy. I mean, you know, look back at any big financial crisis, and you see stuff that would have been inconceivable before the crisis being enacted. You know, you've seen wage and price controls out there, and as I said, gold was confiscated in the U.S., and lots of things happen around the world. You know, during the Roman Empire's big hyperinflation, they instituted price controls, and then when shops started closing because they couldn't operate under price controls, they made it mandatory that sons follow in their father's businesses on penalty of death. In other words, you couldn't just close up shop, or they would kill you. And, you know, so something like confiscating the assets in 401ks or confiscating gold again or something like that, or, you know, they seem crazy now, but they aren't crazy in a historical context of governments losing it because they see their, you know, their financial power eroding and they want to stop that at all costs. So yeah, a lot of strange things are going to happen going forward because we're creating the conditions in which government finances just blow up. And when that happens, whoever's in charge is going to get extremely desperate and possibly very irrational. So name the crazy policy, and we could see it somewhere in the next decade.
Well, then you have a President Trump who may come up with crazy policies. You don't know.
Mm-hmm. Oh, yeah. You know, even in what are perceived as fairly good, stable times right now, it's not inconceivable that the U.S. government does some stuff that surprises us and appalls us. But the really crazy stuff will happen when it's almost across the board. All the major governments are going bankrupt at the same time. Then we're going to see some stuff that will just astound us and terrify us. And we're going to wish, if we haven't already, gotten into real assets as opposed to financial assets, that we'd done it sooner, you know, because the paper currencies are the things that will suffer in that kind of a regime. And real things like farmland and well-chosen energy assets and precious metals will do much better. So that's where you want to have your money as we tip over into the financial crisis that's coming. And again, the timing of something like that is impossible to predict. So dollar cost averaging into real assets is a smart thing to do. And then you hope that you've got some time, that it takes 5 or 6 years for the world to blow up. And you have time to be mostly in real assets. But I think that, most people probably should have, or at least in retrospect, will look back and decide that we should have been doing this for years already. We should be partially, if not mostly, into real assets and out of financial assets at this point.
Canada and the UK have basically sold off all of their gold reserves, while China and Russia have been piling up all the gold that they can find over the last 5 years. Who's got the better policy?
I suspect the East is smarter than the West on that count, and it has been happening. And I think it's happening with the U.S. too. We claim that we still have all the gold we've always had in Fort Knox, but more money or more gold has been flowing into India and China and Russia than has been being produced by the world's gold mines for the last few years, which means some above ground stock of gold has been depleted in order to give those guys the amount of gold that they've been demanding. And we don't know for sure where it's come from. A lot of it, obviously, as you said, has come from the UK and Canada, but that doesn't account for everything either. So some other countries in the West have been shipping their monetary gold to the East. And that's still continuing. Russia and China and India are still buying a lot of gold. And they're treating it as a good that they buy more of when it goes on sale. In other words, when the price goes down, they buy more. When it goes up, they buy less, which means that they're not speculating, and they're not emotionally invested in whatever the price is at a given time. Regular investors tend to buy less of something when it goes down and more of it when it goes up because they're trading on emotion. The Eastern buyers of gold have a long-term plan, apparently, because they're doing the opposite. When it goes down, they buy more, which means they're not caring whether they have a capital gain embedded right now or what that capital gain is. They're looking at some long-term goal, probably involving a monetary crisis out there and a monetary reset when a high degree of gold backing of a currency is seen as an important thing to have. So they might not go back to a gold standard, but the fact that their currencies are backed by large amounts of gold and that their citizens own a lot of gold and silver means that they will be perceived as relatively financially stable at that point and therefore relatively richer. So they'll have more power from a financial standpoint than countries like, for instance, the UK that gets rid of all their gold and has nothing back in their currency except the perception that their government is competent, which might not be much of a perception at the time.
The U.S. dollar had an outside reversal month to the downside in January, another one in March. Could this be signaling a bear market for the U.S. dollar and possibly other currencies?
Well, someday fiat currencies are going to just flat out crash and burn. But there's no way to know when that's going to happen. They fluctuate right now. And when we say the dollar is up or down, we're talking about it relative to the euro and the yen and pound sterling and Canadian dollar. And, that's not really a very valid comparison because all of those currencies are being actively inflated away by their governments too. So, the dollar might be strong, quote unquote, but it's losing value year after year at the same time. So the question becomes, when does that loss of value catch up to the amount of credit that's being created out there and really start to become dramatic? Because we're increasing the amount of credit in the world, which is a negative for the currencies of the world, at a near double-digit rate. But quote-unquote inflation, as it's reported by governments, is just 1 or 2 or 3% for most major currencies, when it should be closer to double digits based on the amount of credit that we're creating. So when that inflation rate catches up to the amount of money that's being created and thrown out into the financial system, then all bets are off. Then we get panic selling of currencies, and we get the Austrian economics crack-up boom that people have been talking about on at least the gold bug side of the spectrum for such a long time. And by that time, it'll kind of be too late to readjust your finances to protect yourself from it. So even though we can't know when something like that is going to happen, we can say with a fair degree of certainty that it is going to happen just based on the amount of credit that we're creating out there. And that when it happens, it's liable to be kind of sudden, because that's how big financial phase changes happen. In early 2000, tech stocks were still going up. Everybody thought they were in a bull market. By the end of 2000, tech stocks had crashed by like 80 or 90%. Well, that's the kind of thing that happens in markets that are overheated. And currency markets, the fiat currencies of the world, are an epic bubble, which means when they burst, they'll burst quickly. So I don't know what any of this means for the dollar in the next 6 months or year, because that's not determined by long-term fundamentals. That's determined by a lot of different cross currents that happen in the geopolitical market and the foreign exchange markets, and I don't think there's any way to predict what's going to happen in the short run. So long answer to your question, and the short answer is I don't know. But I think in the long term, we'll see the dollar roll over a lot, along with the rest of the fiat currency complex.
Are Bitcoin and other cryptocurrencies in a bubble?
They are a fascinating story right now, because Bitcoin, you're seeing all these stats out there where if you bought $10 worth of Bitcoin back in 2010, it's worth $75 million right now. Astounding rates of increase in the value of this cryptocurrency. One of the reasons that Bitcoin is soaring is that the algorithm that determines its supply is very limited. It limits the amount of Bitcoin that can be created to a relatively small number compared to, for instance, the amount of the number of ounces of gold that exist in the world, or the number of dollars that are out there. So the relative value of Bitcoin is perceived as being very high based on supply and demand. But there's maybe a fatal flaw in that worldview, and that is that the supply of Bitcoin is limited by its algorithm, but the total supply of cryptocurrencies is not limited at all. You can create new cryptocurrencies fairly easily, apparently, and then release them, and people use them, because there are a lot of different cryptocurrencies out there already that are seeing dramatically increasing use. So the overall supply of cryptocurrencies like Bitcoin is unlimited, and it's soaring now, so you can't really compare just Bitcoin with dollars or euros or yen or gold. You have to compare the entire body of cryptocurrencies with the fiat currencies of the world. And the cryptocurrencies, are growing like tech stocks were growing back in the 1990s. There were new public offerings of tech stocks every day for a while there. And lately there have been things called ICOs, initial coin offerings, just stacking up out there. So the overall supply of cryptocurrencies could soar at a rate that exceeds that of the fiat currencies of the world, which means maybe in the aggregate, cryptocurrencies are going to be inflated away just as easily as fiat currencies are. So I don't know. I don't know what the end of this story is, because a lot of tech stocks survived and thrived after the crash in 2000. So it's possible that we've got a cryptocurrency bubble blowing up right now, and that at some point it will crash, and most of the weaker cryptocurrencies will be flushed out, and the ones that survive will be rock solid, legitimate currencies, in the same way that Amazon and Google are rock solid, legitimate tech stocks. But we might have to go through that process first, based on the ease of entry in the cryptocurrency market. If any reasonably savvy techie can create a new cryptocurrency and then release it and have it see dramatically increasing demand over time, then there's really no limit to the supply of cryptocurrencies out there. So I think that's a wild card in the Bitcoin story that people don't understand yet.
John, thank you so much for being on This Week in Money.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Mike Swanson, next on This Week in Money.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, editor of wallstreetwindow.com. Welcome back to the show, Mike.
Doing good. How are you doing?
We're doing great in Vancouver. We had our first sunny May long weekend in 17 years.
Wow.
There are kids who have grown up who have never seen a sunny long Victoria Day weekend. Anyway, how is there much sunshine in the equity markets right now?
Oh, yeah. Well, this year, following the election of Trump, of course, the Dow blasted off. But really, since March, the U.S. stock market hasn't barely been doing anything at all. The most defining feature of it is the low volatility. We're seeing historic low volatility. In fact, the VIX, which measures that in the options market, it tells you what the premiums people are paying for volatility on options. It fell to the lowest point seen in over 25 years. And what's really happening is sort of similar to what occurred in the summer 2015, where the averages aren't doing much, the Dow and the S&P 500 are barely moving, but there's excitement among a handful of stocks that are going up almost on a daily basis, and they're exciting the attention of the financial media and traders and so forth. And the ones to watch here are NVIDIA and Facebook and Amazon and Apple. And even today, Facebook and Amazon and NVIDIA are up pretty good, even though the other averages are barely up. And there's actually starting to see some internal divergence here in the market, which means that most stocks aren't really going up anymore, and many are fading. And a lot of the stuff that rallied after the Trump election as part of the so-called Trump trade really peaked out in March. For instance, bank stocks are even. Many of them are actually down year to date. So I think, we had a lot of excitement on that big thrust up, and a lot of money poured into the U.S. stock market in the first few months of the year, particularly in exchange-traded funds, which actually saw record inflows. There's more money put into exchange-traded funds in the first 3 months of this year than ever in a previous 12-month entire period. So there's sort of a mania going on there. Despite that, though, for the past 90 days, not much is really happening. But I think that hides potential setups elsewhere where we can see big moves up. And I'm looking at gold, mining stocks, and silver. And, I know most of the time when we talk, I talk about gold and mining stocks. So I think I'll really focus on silver with you right now because something really fascinating has happened in the silver market just in the past 2 weeks. And that's inside of the futures market. People buy futures contracts to bet on silver, and every week the Commitment to Traders report comes out, which tells us what are small speculators doing what are large commercial operators doing, which includes the mining companies themselves, and they tend to be correct at important turning points in the market. Well, just a few months ago, there's a fairly sizable commercial short position in silver, and silver was trading around $18.50, and then it fell in the beginning of May and down to close to 16, and that commercial short position basically vanished. And last week, it got to the lowest point not seen in over a year and a half, not even at the low of 2016. That tells me that the commercials are very bullish on silver, and I think that we should recognize the $16 level as a solid footing for silver, and I'm happy to buy. You know, we're at 1680, but, you know, whatever, you can't get the exact bottom, and I'm happy to accumulate silver. I'm happy to accumulate silver mining stocks. The same goes for gold stocks, too. But at this point in time, that Commitment Trader Report is more bullish on silver than it is on gold. However, I think both are in a position where they're likely to turn up sometime within the next month, probably around the middle of next month when we have the next Federal Reserve meeting. And so Fed minutes came out today, which hint at a future rate hike. That's what the financial media is focusing on. But I actually think there's a good chance that that might actually be the last Fed rate hike we see in this cycle, which, if that's the case, would be a turning point for gold and silver, because more accommodative Federal Reserve policies or lower rates in the future will cause people to flock into both, much more even than we saw them do last year. I think last year is a preview of what's to come. So why do I think that could be the last rate hike? Well, a week ago, something interesting happened. The Dow fell almost 400 points a day, associated with news surrounding Donald Trump and him firing the former FBI director Comey, and leaks that came out about that firing and so forth that seemed to be bad for him, knowing that 72-hour news cycle. But the Dow fell almost 400 points. What was the most? I don't think Trump's going to be impeached, you know. No, certainly not this year. It's not the news that I found fascinating, but it's just the reaction of the market by dipping like that in one day, and what happened with the Fed fund futures, which factor in expectations of what they expect future Fed policy to be. Now, before that one-day drop, they were predicting an 80% chance of a Fed hike in June, and during that drop, that fell to 60%, and they finished last week at 70%. It does seem they're going to raise rates in June, especially since the market has bounced back up. However, the odds of a December rate hike, another rate hike after that June Fed rate hike, fell to 40% following last week. They remain below 40%. And it just took, the point of all this is that all it took was 1 day's worth of selling in the stock market, approximately 400-point drop on the Dow, to cause the odds of the rate hikes of more than one to diminish that much. And I think at one point, you know, we can expect the stock market to have at least a mild correction and maybe even a big correction. And if all it took was 1 day of selling to make the odds going from 2 Fed rate hikes to one more a week of selling will pretty much take rate hikes off the table and be very bullish for gold and silver.
Mike, what's your outlook on crude right now?
Well, it's interesting. I'm interested actually in shorting oil and betting against it because I think it's long-term in a bear market. However, we've rallied over the past couple of weeks, and we have an OPEC meeting that's going to announce a decision at any moment, and their odds are they're going to extend their production cuts. It's almost a near certainty. And if you look at past OPEC meetings when they have announced such a decision, oil has tended to rally for a couple of weeks. It's already rallied into that meeting and expectations of it. But I think that rally can continue. And we also have a second fact that can support higher oil prices for the next couple of weeks, and that's seasonal factors. Historically, oil rallies into the summer and makes a peak in late June or somewhere between late June and end of July. So I think that's what we're on track for, and I'll be looking to take some short positions against oil when that happens. In the oil market itself, there also has been built up a record oil short position in the first quarter, even a bigger short position they had in 2014, and I think that's noteworthy. I think it means that the oil producers see limited upside, and they're simply trying to maintain higher prices. Some stories that came out over the past week surrounding this OPEC meeting also is suggestive of that fact. On Sunday, Donald Trump took a trip to Saudi Arabia and did some business deals over there, giving them the permission to buy over $300 billion of weapons from American arm manufacturers in a de facto alliance against Iran, is what Trump has basically pledged to give them. Now, what was more interesting is I watched Trump's speech, and he started out bragging about his election and his victory against Clinton, and saying jobs have grown in the United States. And then he made the assertion that he created $3 trillion in value, boasting about the stock market gains, essentially. That was my first reaction. But then after a few moments, I sat there and thought about it, and I realized that he also was playing to the Saudis themselves by talking about stock market gains or financial gains, because that's their goal too. They're trying to create an IPO in the Aramco oil company next year. They're also talking about IPOing their defense industry. They have a plan called Vision 2030 to become a financial powerhouse around the world and diversify out of being solely reliant on oil. And that's something I've heard about, but on Sunday I dug into the details of this, and part of their projection is that they can diversify as long as oil is above $30. They claim they'll be able to make money, and they also had a long-term projection that for the next couple of years, oil may have a cap of around $60 a barrel. So that trading range of between 30 and 60, keep that in mind, because today there's an interesting story in the Wall Street Journal about the American fracking oil industry. Now, if you can remember back in 2014 when oil started to decline, part of the reason it declined was because the Saudis announced an operation to punish American fracking oil companies. Their goal was to put them out of business because they saw them as stealing market share from them, which they did not like. And they wanted to punish them, put them out of business. And according to the Wall Street Journal, that operation has been a total failure, which is a surprise, because usually they get what they want. You know, they did Sunday. They got an arms deal. They got an alliance. In fact, a year ago, the Senate and the House released these 28 pages of the 9/11 report that suggests that Saudi government officials, a couple of them, were somehow involved in facilitating the movements of the 9/11 hijackers. So they got away with that too. But destroying the American fracking oil industry, they did not accomplish. And what has happened is these American fracking oil companies, some of them did go bankrupt, but a lot of them reduced their costs over the past 2 years. And starting last year, they began to short the oil market themselves too, joining in what the Saudis had done and other large producers, and they were shorting at $55 and $60 a barrel, locking in their prices so that they can make a profit even if oil declines again. And what's happened over the past 6 months is that the production coming out of America fracking oil companies has more than made up for the cuts that OPEC enacted. So there's a glut in the oil market. In fact, there's gluts in the storage of oil, and Trump also talked about liquidating 50% of American oil reserves, saying we don't even possibly need them. He's ordered people to do a study of that. The point of all this is that there still remains a glut in oil. There's still heavy shorting in the oil markets by the commercials. The American fracking oil industry has survived, and it's not going away. And that means that OPEC can cut their production, but they're going to have a tough time driving oil prices above $60 a barrel in any sustainable fashion. So my hope is, or what I'm looking for, is a seasonal rally, but probably not one that will get much beyond 60. You know, if it gets to 65, it'll be a temporary blip, and I'm going to be looking to join in with these oil companies and take some short positions. Doesn't mean oil is going to $20 or $10 or something like that, but I think we're in a long-term trading range, and we could see oil go down this fall in the fourth quarter, especially if the stock market hits a snag, the economy weakens, or China weakens. You know, the Chinese stock market has been tumbling too, and it's always hard to tell exactly what's going on in China exactly. It's sort of like a black box over there, but it does seem like there's, you know, some sort of weakness in their economy. And one of the most interesting things I'm watching are agriculture commodities, because they're trading at historic lows when compared to inflation, and there's actually a low commercial short position on most of them, and yet they look like they could actually break down. You know, so at least the charts suggest that's a possibility, and that would be a sign of deflation if that were to happen and oil prices were to fall and economic weakness. So, I think we're kind of in an interesting period right now where the U.S. stock market really isn't moving much one way or the other. Eventually that will change. I think, you know, after the next earnings period, we might see the volatility return to the market, but it's kind of like a quiet time. I think we can see gold and silver, you know, I think they're pausing, consolidating, and if we get a breakout after the Fed meeting or sometime in June, that would be the bullish thing to start to buy. But we might be in like a pause period where the real fireworks would be in a couple months.
Mike, Moody's has just downgraded China's credit rating to negative. Does that give an indication that perhaps China's economy is not doing that well? Or have they pulled the same thing as the U.S. has? They've just driven themselves trillions of dollars into debt.
Well, you know, as I said, it's kind of a black box what's really going on over there. And, I mean, they do have debt problems. They have trouble with their banks. Is it how serious is it? It's hard to say. They've got empty cities. I mean, you know, there's signs of a bubbles in areas. And, an interesting thing is, I read a story too that said that a lot of their investors and stock market players have gone on record margin levels, and now they're cutting that back really rapidly. Well, the funny thing is this is an exact repeat of something that happened 2 years ago where the Chinese stock market crashed in a short period of time, and you heard all these stories of people wiping themselves out. So it's a funny thing. It only took, you know, another 2 years basically for people to try it again. The Moody's downgrade, is that a big issue? You know, typically, you know, they do their downgrades when it's late to the game, and just that one piece of news, I wouldn't take too much stock in it. They downgraded U.S. debt a couple years ago, and, you know, nothing really has come out of that, you know, as a result, at least not yet, because I would take it as a sign of, you know, potential problems down the road, but not, you know, anything meaningful, you know, for next week.
Of course, too, in China, they like to go after people they think are manipulating the market, but they don't tell you what the exact rules are. And I've heard stories now where their exchange enforcers will invite you in for a meeting. They look very nice. The headquarters is a very pretty building. And then they ask, you wouldn't mind exchanging your jacket and tie for something more comfortable, would you? and you end up being, burned with cigarettes and forced to stay awake for days until you sign a confession saying you've been manipulating the market.
Well, that's scary. But, I bought Chinese stocks a couple in 2008, that summer, 2009, after the stock market bottomed and so forth. And at the time, they were doing very well. I mean, they were like the top performing stocks in the world for a couple months. And I bought a couple of them, and I was just using the information I would get off the internet about their earnings and earnings projections, valuations, and what happened was they went up, and then it turned out all these projections and data were fake. They were just made up, basically, and it was, I ended up breaking even or losing some money on these trades. And that was my lesson about China, is it's not really regulated and it's a lot of fakery. And I even, soon after that, I heard stories where someone was shorting Chinese stocks and investigating some of these companies, and they're just shell companies with owning no factories while they're claiming they were, or else it was just like, buildings that were, falling apart and stuff like that. So, I'm sure some of them are real, some of them are fake. I think you need to go over there to tell the difference, and just relying on the data off the financial websites isn't enough to do it.
Well, apparently going over there isn't good enough either. Some places have set up fake factories where they bring groups of investors in, they tour the factory, and then 2 hours later, all the signage on the factory has changed, and they bring another group of investors in.
Wow. Well, it's, like something like 10 years ago, someone showed me a job opportunity for China. For Americans, you could go over there and they would pay you $100,000 a year to be an actor. And not on TV shows, not in movies, but an actor for corporate boardroom meetings, where you would just play the role of being a boardroom member as an American, to reassure foreign investors that they've got an American there and it's more legitimate or something. So, it's kind of, you're not a translator, you're just an actor. Just pretend to be, on the board of directors.
Yeah, I saw a documentary on the same thing where one day the guy's a doctor, the next day he's an architect, and he supports their measures and their stock.
Anyone in the financial world or following the financial news, you see all kinds of crazy things in the United States, and Bernie Madoff and, whatever, all these scandals over the past 20 years. But probably China is probably nothing like the Chinese stories.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. And that wraps up our show for this week. We'd like to thank our guests Ross Clark, John Rubino, and Mike Swanson, and thank you for listening. Stand by. Right after the show, we'll have company showcase updates with Blind Creek Resources President Brian Fowler and American Manganese President and CEO Larry Ray. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. We're speaking with Brian Fowler. He's the president of Blind Creek Resources. Welcome to the show, Brian.
Thank you, Jim.
Brian, what can you tell us about Blind Creek Resources?
Blind Creek has been listed on the TSX Venture Exchange under the ticker BCK since 2004. The company is focused on lead, zinc, silver, and more recently gold exploration and development in Western Canada. Until this spring, Blind Creek has essentially been dormant in light of the prolonged downturn in lead zinc prices, but with the recent renewed interest in zinc due primarily to supply issues and overall price increases, the company believes now is the time to renew efforts to develop Blind Creek into a major silver lead zinc explorer and developer.
What's the capital structure of Blind Creek?
Blind Creek has 20.1 million shares issued with no warrants. 43% of these shares are held by company insiders, and our current market cap is just under $5 million.
Why is zinc such a hot commodity today?
Good question. According to experts such as Jonathan Lang, Wood Mackenzie analyst, he says over the next couple of years, this represents a pinch point of zinc concentrate supply, with mine closure-related cuts expected to outweigh new output from projects. Wood Mackenzie further predicts a peak price of $1.80 per pound in 2018. Zinc is currently at $1.19 last I looked. James Fraser, the editor of Mining Stocks Investor Guide, stated that the best way for investors to play a zinc price move would be to invest in zinc equities.
What can you tell me about Blind Creek's projects?
Blind Creek's flagship property is a 100% owned blend project situated 63 kilometers northeast of Keno Hill Mines in central Yukon. Blend is one of the largest undeveloped zinc, lead, silver deposits in western Canada. It's over the years seen more than $9.2 million in past exploration expenditures, with $5.2 million of that by Blind Creek. It's a substantial amount of exploration drilling, nearly 25,000 meters of drilling in 125 drill holes. In 1991, Billiton estimated a historic open pit resource of 19.6 million tons, averaging 3.04% zinc, 2.8% lead, and 56 grams per ton silver, representing 1.3 billion tons of zinc, 1.2 billion tons of lead, and 35.3 million ounces of silver. This resource is this was in a shallow sulfide-only component of the deposit, and I have to state for your listeners that this resource is not NI 43-101 compliant. It's historic, and Blind Creek is not treating the historical estimate as a current mineral resource or mineral reserve, and the historical estimate really should not be relied upon. The project has a number of exploration and development upsides. Past drilling indicates an overall increase in grade at depth and along strike, and that the deposit remains open both along strike and at depth. There is excellent potential for combined open pit and an underground mining operation with additional exploration successes, and recent advances in oxide, zinc, and lead recovery processes also offers a significant resource upside. Blind Creek's planned 2017 exploration program will focus on further defining and qualifying all these upsides.
Now, Blind Creek recently acquired the historic high-grade Engineer Gold Mine in northwestern BC. What can you tell us about that in light of Blind Creek's stated focus on silver, lead, and zinc?
That's a very good question, Jim. Yes, Blind Creek is and will continue to be focused on silver, lead, zinc exploration and development at Blend. The company is committed to adding value to shareholders by advancing the Blend property to the resource and PEA stage. That's not to say that the company is not evaluating other quality silver, lead, zinc acquisition opportunities as well. When it comes to Engineer Gold Mine, which the company acquired this spring from BC Gold Corp, Blind Creek had a unique opportunity to acquire an historic and fully permitted high-grade gold mine for pennies on the dollars historically spent on this relatively unexplored gold system. Engineer Gold Mine has a high-grade NI 43-101 gold resource and is fully permitted for small-scale gold production utilizing the on-site mill. The previous owner was focused on small-scale gold production and lacked the capital to follow up and drill test numerous exploration targets. Blind Creek owns Engineer Gold Mine outright. The company nearly tripled the property size by staking this spring and is currently working on an NI 43-101 technical report that is expected to recommend continued exploration for additional high-grade veins and bulk tonnage gold mineralization.
What are Blind Creek's exploration plans for this season?
At Blend this year, Blind Creek is positioning to conduct additional metallurgical studies, geochemical analyses, geological mapping, sampling, geological modeling, step-out and down-dip drilling, and resource estimation. Results will be documented in a NI 43-101 technical report and provide the basis for a PEA study for next year. At Engineer, Blind Creek is, as I said earlier, currently preparing an NI 43-101 technical report that is expected to recommend a 2017 program consisting of soil geochemical surveys, trenching, geological mapping, sampling, and diamond drilling. The company is also assessing a small-scale mining and gold production opportunity defined by the previous owner.
Well, that sounds like it's going to be a pretty busy year for you, Brian. Anything else you need to tell us?
Yes, it's going to be busy for sure. I guess I'd just like to let the listeners know that Blind Creek will be attending the International Metal Writers Conference at the Vancouver Convention Center this coming weekend, May 28th and 29th. But Blind Creek will have a booth. We're at booth number 202, and I have the opportunity to speak about the company at 2 p.m. on Sunday. It should be a great show, and it'd be great to meet people that are interested in zinc and Blind Creek. I guess lastly, check us out at our website, www.blindcreekresources.com.
Is Blind Creek on any stock exchange?
Blind Creek is listed on the TSX Venture Exchange. Ticker is BCK.
And again, where can people contact you?
My work number is 604-617-8191.
Brian, thanks a lot for chatting with us.
Thank you, Jim.
We were talking with Brian Fowler, president of Blind Creek Resources, on May 23rd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. We're speaking with Larry Ray, CEO and president of American Manganese, on May 26th. Welcome back to the show, Larry.
Well, thanks, Jim. I'm happy to be back from the Cobalt Show in Morocco.
Where it was a chilly 40 degrees Celsius?
Yeah, it was a balmy. I call it balmy 39 to 40 most of the days that we were there. And, that certainly is a rude awakening when you step out into that.
Larry, do you have some hot news for us out of Morocco?
Well, Jim, I've got, let's say it's really interesting news. Of course, we were at the Cobalt Conference. All our shareholders know that. It was attended by some of the big cobalt producers and the end users, and I'd say there's between 150, 200 attendees. We were certainly happy to be able to present our recycling program at the show, and I have to say that Norm Chow did an excellent job in doing the presentation. He was clear, concise, and enthusiastic and passionate about what he was doing. And it was very well received from the people at the show, and I've had confirmation on that by the president of the Cobalt Conference, and he basically said that everybody he talked to remarked favorably on it. So that was a great thing for us. And, that way we put the message out to people that are in the industry to let them know that we are alive and well. That said and done, we met a lot of people. We had several one-on-one meetings, and we'll see if those meetings bear fruit in the next few weeks or few months. But there's definite interest in our project. But the one thing that I found at the show was that they kept downplaying the recycling. And this is, most of the presenters were talking about the supply, demand and supply. That's what the show was all about. And there's definitely a shortage, and it's building. and they are really looking at copper mines to fill that shortage, or some of the pure cobalt plays, and some of that will happen. I doubt if any copper mines will go into production at these levels, and so that leaves recycling, and recycling was at the bottom of the list. And in some cases, these guys talked about 15 years before a battery was ready to be recycled. Well, that's the party line of the EV producers, the electric vehicle producers. Rather than face up to the fact that they're going to have to recycle, they're trying to put it off into the future by saying second use for Powerwall units. And I had a good chance to address that at the Roskill Roundtable. There was, I'd say somewhere between 70 and 100 people in there, and I went to the roundtable discussion. I saw there was a group of chairs in a big circle at the front of the class, and I went down to the front of the class and sat there. And, the guys were talking about the usual, the shortages, where is it going to come from, and how are they going to address it, and all of these things. And in the last 15 minutes of the talk, I started it out by saying, look, Jim, I said, look, guys, I said, I'm a layman, but I'd like to give you a layman's view on what's happening. And so I gave them a bit of my history on my newsletter and everything to do with commodities. And I said, I see that recycling's out there 15 years. I said, that's not a reality show. The reality show is that those batteries will have to be recycled as soon as they reach the end of life. If not, where are they going to get the cobalt for the next battery? You're either an EV manufacturer or you're a Powerwall unit manufacturer, but there's no way you can be both. And I'm sure that the Powerwall idea will be sacrificed to get the cathode materials you need for your batteries. I said, there's going to be some substitution. There's obviously cobalt, will be added in a lesser amount, and a lesser amount, and a lesser amount, but that's not going to help the deficit. And so I got a good plug-in for the company. The one thing I'd like to mention is we've been told by government sources in the U.S. that cathode material has a 10% rejection rate. They call them scraps. And that's when you take the cathode material and you put it on a sheet of aluminum, which is the foil. And then you cut out enough to do a run of batteries, and if there's something wrong with those batteries, they scrap the rest of the sheets, or all of the sheets. They all end up in a recycle yard. We know that because we were approached to maybe recycle that material, but it was a very binding agreement, and we didn't enter into it. And but that's 10%. So if there's 45,000 tons a year of cobalt used, that means there's 4,500 tons of cobalt to recycle each year. That's a whole business in itself. And, so we have to look at the reality. I also mentioned that there's 280,000 EV cars reached the end of life in 2015. It's expected to be close to 500,000 in 2020. So, the reality for a company like any company out there, it's a huge business if you can recycle those batteries today and now, not waiting 15 years. And I tried to get that message across, and I took the rest of the time that was there, 15 minutes, to do that, but I was very satisfied that I did get the message across. So, all in all, I think it was a very progressive show on behalf of the shareholders of American Manganese Inc., that we were well represented, and the word is getting out, and that's the big thing, the word getting out. It's obviously getting out because we're getting, there's all kinds of recycling companies or companies talking about recycling cropping up almost every week or so. And we can't comment on those because they don't put any statistics out with their announcements about recycling. If you have no statistics, we can't comment on it. So, but the show was excellent, and I expect that will bear fruit somewhere along the line. And I expect that we'll have other meetings resulting from the show. And that's all I can say. Some of the stuff I already have confidentiality agreements on, and I can't talk about the parties that I met with. But let's just say that they're very significant.
Larry, for new listeners, can you tell us a bit about American Manganese?
Well, American Manganese is a critical metal company that's focused on taking their existing patented process for producing electrolytic manganese dioxide for the battery industry, electrolytic manganese metals for the stainless steel and specialty metal area. But our major focus now is that we can take the patented process that we use and adapt it to recycling lithium-ion batteries, and that's the focus of American Manganese at this time.
Larry, what platforms is American Manganese traded on, and what's its trade symbols?
It's traded on the TSX Venture Exchange under the symbol AMY. Its website is AmericanManganeseInc.com. We also are traded in Frankfurt, the symbol 2AM, I should say, and the symbol AMYZF in the U.S. I can be reached at lray@amymn.com.
And Larry, people can call you directly as well at 778-574-4444, right?
Yeah.
Larry, thank you so much for the update.
Okay.
My guest has been Larry Ray, President and CEO of American Manganese. We were chatting on May 26th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.